Okay, so we're recording and we are ready to go. So first of all, everyone who is attending, thank you all very much for attending this seminar tonight. My name is Shannon Dwyer. I am the digital banking strategist for Dutch Point Credit Union, and I will be your host for this seminar. So welcome. Please also let me take a moment to introduce my co-host, Maria Vining, who is the credit union's Vice President of Lending. Hi, Maria.
Hi, Shannon. Thank you for the introduction. As Shannon said, my name is Maria Vining. I'm the Vice President of Lending here at Dutch Point, and I oversee collections and lending here.
Excellent. So Maria, thank you for joining me for this seminar. And again, thank you to all of our attendees. We are excited to have you join us today to learn about all things credit. We do have one quick housekeeping note before we get started. You will notice that there is we have enabled a chat and a Q&A feature on the webinar so that you can submit any questions if you have any. We will do our best to answer your questions that you may submit at the end of the presentation, but do know that if we are unable to answer your questions during the session, we will follow up with you after its conclusion, okay? So with all of that said, let's get started. We're gonna just take care of getting our slideshow up and ready to go. And here we go. All right, understanding credit. Build a strong credit history. So first, let's discuss some seminar objectives. We'll cover a number of topics during today's seminar. So these topics will include why credit matters. Now, credit's a very important part of your financial well-being, so we'll cover why it matters. Understanding your credit report. We'll talk about what's in your credit report and what others see when they view your credit. We'll talk about what makes your credit score. We'll take your credit score and we're going to break it down with you, tell you how it's calculated and what pieces are important when determining your credit score. We'll talk about using credit wisely. We'll cover the best ways to maximize your credit so that you can maximize your credit score. Also, tips to build or rebuild your credit. Perhaps you're just starting out in the world of credit. We'll give you some tips on how to make that transition best. Or perhaps you're looking to rebuild your credit. If you've had some issues with your credit in the past, we'll share some tips and tricks on ways that you can rebuild that credit in a way that's best for your financial health. And then questions. Again, please use the chat or the Q&A feature to submit any questions you have along the way. All right. So first, we will discuss why credit matters. Credit provides someone with information about your financial stability. It can determine your ability to get things like loans or credit cards, an apartment or a house, insurance, a phone. Now, a question that often comes up is who can view my credit report? It's important to note that lenders, landlords, insurance companies, phone companies, even potential employers all can view your credit for services and potentially make decisions on what you are offered based on your credit. Your credit can also determine your interest rates on loans. This ends up being the price you pay for that loan. So this can also impact your monthly payment. And finally, credit positions you for financial success. Building and maintaining positive credit will save you money, and it will give you peace of mind knowing you have the ability to access funds when you need them most. So to do this, it's first important to understand what makes up your credit report. So, question is, what is a credit report and what's in it? A credit report is a detailed background of your credit history. It provides information about your identity, your borrowing habits, and your past and present loan obligations. Your ability for loan approval and the interest rate you will pay is partly determined by your credit report and your credit score. Now, there are 3 credit bureaus that collect and maintain your information. You may have heard of them. They are TransUnion, Experian, and Equifax. Each bureau independently manages its own records, and not all lenders report to all 3 bureaus, but most do. Even though there may be differences in what each bureau reports, all of your information with each bureau must be accurate. So it's important periodically to review each one. Your credit report includes several pieces of important information on you, such as, first, your personal identifying information, your name, your current and previous addresses, date of birth, social security number, and your past and present employment information. It includes your current and former credit accounts, such as credit cards, loans, mortgages, and student loans. Details on each one will include the lender name, the date the account was opened and closed if it's closed, your credit limit or the total loan amount you took out, your current balance, and your repayment history. Credit can contain public records too, such as bankruptcies, judgments, liens, and civil lawsuits, and possibly foreclosures. Also, obligations that were not satisfied and sent to a collection agency, such as utility bills, medical expenses, or closed bank accounts can be included in your credit report. And finally, your credit includes 2 years worth of credit inquiries you initiated. Now, these are often referred to as hard credit inquiries. They will be for things like loan and credit applications. Your credit report will not show what is called a soft credit inquiry. Let's take a moment to discuss the differences between these 2 inquiry types. So first, an inquiry is simply a record that someone has looked at your credit report. Inquiries can fall into 2 categories: soft inquiries and hard inquiries. First, soft inquiries. Soft inquiries are only shown to you on your personal credit report. And since they do not appear on a report used by a lender, like DutchPoint, they don't affect your credit score in any way. Soft inquiries also can occur when you request your own credit report, when you receive a pre-screened or pre-approval credit card offer in the mail. I know a lot of us get those every day. Or an insurance quote, or when a lender with whom you already do business can do an account review, or even for possibly employment verification and background checks. Now, a hard inquiry will occur when you apply for credit or some other kind of goods or services. By submitting an application, you authorize someone else, such as a lender or a credit card issuer, to review your credit report. Potential creditors review your credit to weigh the risk of extending new credit to you. As we said before, hard inquiries remain on your credit report for 2 years. And the number of inquiries can impact your credit score. but usually do know they only impact your score for the first few months after the inquiry. And that leads us into our next discussion point, your credit score. So let's start with discussing what exactly is a credit score. Credit score is a calculated number that represents your credit worthiness. For lenders, it's a number that can determine your likelihood to repay a loan to them. The higher the credit score, the better. Remember that. Your credit score does change over time, depending on multiple factors, which we will discuss today. There are many different credit scores out there, certain models used by different companies that are calculated differently. Now, one example you may have heard of is called a Vantage score. It's typically used by various credit monitoring companies, like Credit Karma is an example of one of those. Lenders, like Touchpoint, use what is called the FICO score model. FICO scores can range from 300 to 850. Again, remember, the higher the better. And as we said before, each model calculates a score differently, which is why you may see differences in them. Let's now break down the factors that influence your credit score. As you can see, we have a graph here. In this graph, there are 5 pieces that are used to calculate your credit score. And we're going to go into each one in more detail, but to start, let's briefly review each piece. The first we're going to review is payment history, which makes up 35% of your score. The biggest question that gets asked and reviewed for this piece of calculation is, do you pay your bills on time? Now, the next largest factor is called capacity. Capacity makes up 30% of your credit score. Capacity is calculated by comparing your available credit limits versus what you owe. The next piece that gets reviewed is the length of your credit history, and this makes up 15% of your score. This piece reviews how established your credit history is, how long you've had that credit. Then your level of new credit is reviewed, which makes up 10% of your score. This area looks if you're increasing your debt obligations by taking out new loans and credit cards. And finally, the different types of credit currently in use is reviewed, and that makes up the last 10% of your score. It checks to see if you have what we call a healthy mix of different credit types. Now we're going to review each piece in greater detail. So first comes payment history. It's 35% of your score. It's the biggest part in determining your score. It includes payments on installment loans, credit cards, mortgages, student loans, and more. Good payment history has a significant impact on increasing your credit score and maintaining a high credit score. One late payment can have a serious negative impact to your score, and your score can go down much faster than it can go up, so do remember that. If you do have past due items on your credit, things like the number of past due items, the amount that's past due, and the length of time they've been past due will be reviewed in this piece. Now, it's important to note that the older your past due history is, the less it comes into the calculation of your score. So, items that are currently past due today will harm your score more than items that were past due, let's say, 2 years ago, but now you're paying them on time. Keep in mind that collection accounts and legal actions reported to your credit will also harm you. They come into play during this piece of your credit score calculation. All right, next we will discuss amounts owed, which is also referred to as capacity. This is 30% of your credit score. Now, we all know that it's important to pay our bills on time and have good payment history. But did you know the second most important piece of your credit score is how much total debt you owe? Capacity takes a look at your available credit versus the balances that you owe. And the higher capacity that you have, the higher your credit score will be. Now, we've created an example to share with you to better understand capacity. In this example, we have member 1 and member 2. Member number 1 has 5 credit cards total and has $50,000 in credit limits across those 5 credit cards. Member number 1 owes $10,000 in balances across those credit cards. That means that member number 1 has $40,000 of availability, which equals 80% capacity. Now let's look at member 2. Member number 2 has 2 credit cards, and in total, those 2 credit cards have $5,000 in limits. Now member number 2 has $5,000 in balances. That means member number 2 has 0 availability, which means 0% capacity. So we want to be in member number 1's situation and have as much capacity as we possibly can. A good rule of thumb is to only ever use up to 50% of the credit that you have available to you. So always keep your balances, if you can, at or below 50% of your credit limits to keep your capacity on the higher side. So capacity is very important. Okay, up next is your length of credit history. This is 15% of the calculation of your credit score. How long your credit has been established has weight on your credit score. Lenders typically want to see reliable, on-time payment history over a long period of time. In this case, older is better. And that's why it's important, very important, to begin establishing credit as early on as you can. The length of time you've had both revolving accounts, like credit cards, and installment accounts, like car loans, will be reviewed. It will also review how long it's been since your accounts were last used. This is when it's important to note that closing accounts can have an impact on your score. So let's review an example of that. Let's say that you've had a credit card open for 10 years. It's your oldest credit card, and you don't use it that often, and you decide you just want to close it out, right? Not only will closing it impact this piece of your credit score, because that length of time you've had it open will no longer come into play when calculating your score, but also you will reduce your capacity, as we just discussed capacity, because that credit limit will no longer be available to you. So closing an account can actually impact multiple areas. So it's important to keep that in mind. All right, the next piece we're going to review is the amount of new credit you can have, and that impacts your credit score. This is 10% of your credit score calculation. New credit can either help or hurt your score. So it's important to review a few things before opening new credit accounts. First of all, be conservative with the amount of new credit you open. It's important to space out new credit rather than open several new accounts at the same time, or within a short time period. Lenders might think you're running into financial difficulties if you've opened too much new credit too quickly. It's also important to limit the number of credit inquiries you have for these same reasons. Too many inquiries can signal to a lender that you're shopping excessively for credit. Even if a lender pulls your credit and you don't end up with a loan from them, that inquiry is a hard inquiry and it will remain on your credit report for 2 years. So only get your credit pulled if you absolutely have to, and only open new credit when you absolutely have to. Finally, the mix of different credit types you have can impact your score. This is 10% of your credit score calculation. Now, I want you to remember this saying, not all credit is created equal, okay? It's important to have a healthy mix of different types of credit. And this shows a lender that you can be responsible with various credit options. It's recommended that you have a mix of revolving accounts, like credit cards and lines of credit, and installment accounts. Those would be like car loans, personal loans, and mortgages. Avoid having too many of one credit type and none of the other. So the key here is to have a healthy balance of both. Okay, now at this time, I'd like to turn the seminar over to Maria, who will cover ways to use credit wisely and provide you with some tips on building or rebuilding your credit.
Well, thanks, Shannon. That was a lot of very, very good information. So now that we covered credit and credit scores, we'll move on to building credit. So, is having no credit bad? Well, you haven't done anything bad, but it is very common to have a hard time getting credit when you have no credit established. Why is that? Well, it's unknown to lenders what type of borrowers you are. Are you a disciplined borrower and you will pay every payment on time without causing any loss to the lender? Or are you more of a relaxed borrower? Type of, I'll get to it when I'll get to it. Do you have an emergency fund to rescue you in unexpected hardship situation? Or will you easily fall behind on your payments? So the only way that lender knows what kind of borrower you are is by reviewing your credit and your credit score. So in order to show that you're a reliable borrower, you have to build your credit. So my advice to you is plan ahead. If you want to get a $20,000 car in 2 years at the best terms and rates offered, you need to plan ahead. You need to start building credit way before you really need to borrow. And you may ask me, why? Why do I need to borrow if I don't really need to borrow? Well, as Shannon mentioned, lenders base their loan rates on the individual's credit scores. And if you don't have credit history and you don't have a credit score, you will get a higher interest rate on your car loan. Even if you will be able to get the loan, you may not even qualify to get the loan with no credit history. And since the car loan is a higher loan amount and typically would be at the higher interest rates, for example, our interest rate for no score auto loan would be at 6.25% for 5 years. At the end, it will cost you far more to have that higher amount car loan at the higher rates than if you borrow today a secured loan at the secured rate, which with us, it's a little over 3%. So in general, when you're establishing credit, it's good to open an installment trade and 2 revolving trades. So what does that mean? What is an installment loan? It's a credit obligation that has a set monthly payment. Typically, it would be a car loan or a personal loan. And a typical revolving obligation would be a credit card. So there's no real set monthly payment. Your balance may go up, down, or you may not even have a balance or payment at all. So you should aim to get a small secured loan and 2 small credit cards to start yourself off building credit. So start small. Why do I say that? Well, don't apply for a $5,000 credit card if you have no credit. Low limit application is much more likely to get approved. It shows the lender that you understand how borrowing works and that you understand that you have no credit and you're looking to build it with small amounts and that you're prudent with your finances. Offer security if you can. Maybe you saved and bought your first car in cash. It doesn't have to be a $20,000 car. Maybe it was a $5,000 car or $3,000 car. The amount really doesn't matter. Now is the time to put that car to work for you. You can actually borrow against your car and start establishing credit that way. Cosigner is another good option. You can ask a family member to co-sign a loan for you. Or it's not quite a cosigner, but also ties into a family member. You can ask them to add you as an authorized user to their credit card. I see that a lot. I see a lot of parents that add their children as an authorized user. Being an authorized user will help your credit score. However, there is a downside to that. If the primary borrower on that credit card accidentally misses a payment or maxes out the credit card, it will not only affect their credit score, but it actually will affect your credit score and your credit history. Another good option is secured by money on deposit. So if you saved some money, it doesn't have to be a lot, you can deposit into your account and borrow against it. And since there is really no risk to the lender that you'll ever default on it because they're holding your money, the loan will be at a relatively low interest rate, which I mentioned, a little over 3%, and it's almost guaranteed to be approved. Or you can do the same thing with a credit card, deposit money into your account and get a credit card that limit corresponds to the amount that you deposited. And the last bullet point is the store credit card. So why did it even make the bullet point? Well, it's actually a pretty good vehicle to establish credit. And I actually devoted my whole next slide to it. So store cards, why are they helpful in establishing credit? The biggest advantage of a store card is that they're easier to get than a major credit card. And they also typically have no annual fee. They don't require a security, a deposit in your account. And not only that, they come with perks and rewards. So it's not a bad deal. But obviously I cannot mention the negatives of the store cards. They typically have much lower limits, much higher interest rates if you don't pay your balance in full every month. Their rewards are limited use. You can only use them in the store that issued them. They also limited use unless they're affiliated with a major credit card. You can only use them in the store that issued them. And there's also that pressure temptation to spend because you sure will be bombarded with their marketing material and offers 30% off if you do this, or come in today and you'll save X amount of money. So you have to just be careful with that. So with that, let's move to the next slide, best way to use your credit. And here I'll be referencing a lot of what Shannon already stated. So the most important thing that you can do for your credit in establishing your credit and maintaining your credit is to pay your bills on time. It's 35% of your credit score, and you really have to take it seriously. How do you use your credit so the next time you apply for your loan, you're viewed as a reliable borrower and given the best possible rates and terms? Well, pay on time. It doesn't matter if you pay off in full, if you make a double or triple payments. What matters is you pay on time all the time, at least your minimum required payment. You may want to consider to set up an auto pay so your payment gets paid automatically from your account so you never miss your payment. Far too often, I hear an excuse for a missed payment that the borrower was planning to double pay the next month. Well, it doesn't count. If you miss a payment, it's a very bad mark on your credit report. It's a bad practice and will hurt your credit and your credit score. You have to pay at least your regular monthly payment every month. Capacity, that's the next bullet point. So it's 30% of your credit score. So keep your balances low. Do not max out your credit cards. As Shannon mentioned, having available credit will help boost your score. And it's not the amount of debt, but the relation of that debt to your limit. So if you have $500 limit, don't spend $499. That results in zero capacity. The same goes for $3,000 limit. Don't spend $2,999. However, we're all human, and let's say you do have a low credit limit and you need to make a large purchase that will use pretty much your entire line. What I advise you to do, to start making payments immediately to reduce your balance, regardless of your due date. Most credit cards report only once a month to the credit bureau, and typically it's done at the time that your statement is generated. So as long as you pay down your balance by that time, you will not appear to be maxed out. Apply and open new credit only when needed. Opening new credit sends a red flag to lenders. Why are you seeking new credit? Are you in trouble? Are you trying to supplement your income with the money you're getting from your credit card cash advances? And also, let's say it's not even credit cards, but you got approved for large car loans. Can you manage that newly acquired debt? Don't close your oldest credit cards. As Shannon said, the length of the time that your credit history has been established plays a major role in your credit score. So you cannot control how long your credit has been established, but you can control by not closing your oldest credit cards. Let's say you had a $500 card, now you have a $5,000 card. You want to close that card that you're not using it, you shouldn't. It's the open date, it's not the limit that counts. Keep your oldest credit card open. And the last one is also extremely important, is review and dispute inaccuracies on your credit report. You must review your credit report to make sure that all the reported information is accurate. It often happens that when people have the same last name and first name and live at the same address, and the only difference is junior or senior, their credit information gets commingled on each other's credit reports. But that's not the only case when it happens. You also have to watch out for fraud. If someone gets a hold of your personal information, they may be able to apply and obtain a loan or a credit card in your name and start charging it, and it will report to your credit bureau. So that brings us to the next topic. How can you check your credit and how can you dispute inaccurate information? There was a federal law that was passed, the Fair Credit Reporting Act, and it requires each of the nationwide credit reporting companies, Equifax, Experian, and TransUnion, to provide you with a free copy of your credit report at your request every 12 months. The FCRA promotes the accuracy and privacy of the information in the files of the nation's credit reporting companies. During the pandemic, you can actually obtain your credit reports, free credit reports, more frequently. So in order to take advantage of the FCRA, you need to go to annualcreditreport.com or call 877 number or download and mail in annual credit report request form. You should not contact the 3 individual nationwide credit reporting companies. They are only required to provide free annual credit reports through annualcreditreport.com or phone or mail-in form. If you're really worried about your credit report, for example, if you've been a victim of fraud, then you should stagger your credit report requests. Don't get all 3 at the same time. Let's say you can get your TransUnion in January, Experian in June, and Equifax in September. So you kind of cover the whole year with that. So beware, that's another thing that I really wanted to mention, beware of the imposter websites. They mimic the annualcreditreport.com, but they're not the real deal. Typically, they're trying to sell you the credit monitoring services or selling you credit scores. Annualcreditreport.com does not provide you with your credit score, but it gives you an opportunity to self-review your credit report and dispute any inaccuracies. At the end of this presentation, Shannon will give you information how to get a free, personalized, and in-depth credit review of your credit report that includes your credit score. So now let's move on to some tips on how to rebuild credit. So I get a question, what's harder, to build credit or rebuild credit? In a lot of ways, they're similar. On one side, I can say it's a little harder because you already showed propensity, for example, not to pay on time or some other credit hiccup. On the other hand, rebuilding credit somewhat later in life, you may already have stable and established employment, and lenders will take that into consideration. Or also, if you have a valid reason for the credit event, lenders may look more leniently on your loan request, for example, a serious illness or loss of job. In most ways, rebuilding credit is very similar to building credit. But let's say that you don't have any bad credit. It's just that you have too much credit. Somehow you overextended yourself, and now you have, let's say, 10 credit cards, and all of them have balances. And you're noticing that it's getting harder and harder to keep track of them and pay on time. Not only that, having that many credit cards with balances, you have noticed that it brought your credit score way down. So what should you do? Well, great thing that you actually have options. So my first suggestion would be a consolidation loan. Here at the credit union, we offer consolidation loans at a very reasonable rates. Sometimes we run promotions as low as 6.99 for 5 years. Most credit cards are double or triple that rate. And if you consolidate all your cards, you will get one easy monthly payment. You will also improve your credit mix, and you will save money, not to mention the hassle of remembering to pay all of your credit cards on time. My advice is, even though it is a little controversial on closing credit cards, but my advice is close all of them except for 2 oldest credit cards. It will show the lender that you're serious about paying down your debts, and it will also lessen the temptation to reuse them. If you're unable to get a debt consolidation loan, and that happens, there are other ways to tackle your debt on your own. First of all, you will need to make a list of all of your credit card balances, minimum monthly payments, and interest rates. And option one that I like a little better, just because the rewards come a little quicker, you start chipping away at the card with the lowest balance, since you will pay it off fastest. Then take the money that you were applying to that card and start chipping away at the next lowest balance, and so on. And meanwhile, of course, you're making minimum payments on all of your other cards. The other option is to work on your credit cards in the order of the highest interest rates. And that would save you the most money, obviously, because of the interest rate. And the rest of the steps to rebuilding credit is pretty much the same as building credit. Start small, offer security, get a cosigner, and get a secured loan or a secured credit card. My final words on rebuilding credit are on the next slide. So if there's anything about rebuilding credit, is be patient. There's no quick fixes. And the farther away from the derogatory event you are, the less influence on the score it has. Now let's look how some of the information that's reported in your credit report affects you and for how long. So you may have questions. So I had a car loan, I had a few late payments, but now it's all paid. It should not affect me. It should just drop off my credit report. Well, that's not correct. A closed account with late payments in its history must be deleted after 7 years. So it can stay on your credit report for up to 7 years. On the other hand, a closed account with no negative information in its history will be deleted after 10 years from the date that it's closed. So on the next slide, we'll discuss another credit event that comes from the life events. So life happens. Sometimes individuals are forced to file bankruptcy. There are more than those two types of bankruptcy that's on the slide, but they're the ones that we see most frequently. So Chapter 7 is a straight bankruptcy. It's kind of like a forgiveness of debt bankruptcy. Most debts are discharged or forgiven. The only ones that are typically not dischargeable are alimony, child support, most taxes, and student loans. Individual cannot file Chapter 7 for another 8 years, and it will stay on the credit report for 10 years. Chapter 13 is a repayment plan. It's not a forgiveness plan. It may include all debts or only some debts. Individual cannot file another Chapter 13 for 2 years, and it stays on the credit report for 7 years. So you may ask if both bankruptcies affect your score the same way, or one is worse for the credit score. Well, they affect the score the same way. It's a derogatory event. But lenders do tend to look more favorably at Chapter 13 because it's a repayment plan. Some of your debts will get repaid. As an example, a mortgage lender will require you to wait 4 years after Chapter 7 discharge or dismissal before you will be considered for a mortgage. Chapter 13, you can apply for a mortgage 2 years after discharge and 4 years after dismissal. So you're penalized a little less for Chapter 13 versus Chapter 7. So now that I have discussed the ways to build and rebuild your credit, what is your next step? Well, and this is my personal opinion, building or rebuilding, turn to your credit union. We're more flexible and we offer personalized decisions based on your individual situation. We do not have a credit score cutoffs like some banks do. So you are not going to be automatically declined just based on your credit score. We look at your entire financial picture. And we also not just evaluate your credit request, but we go a step further to uncover if there's a better solution, a better way, or a better product to help you achieve your financial goals. So on the next slide, I will tell you a little about a few options that we offer to build or rebuild credit. So of course, we offer all the standard loan options such as car loans, personal loans, mortgages, home equity loans, lines, even cashback credit card, to name a few. But we also offer specialized loan products to help our members build or rebuild credit, and that's what I'll focus on this slide. So we offer secured loans and secured credit cards. We also offer low limit unsecured credit cards. And my personal favorites are first-time auto buyer and family pricing on auto loans to help you get into that car. So you'd ask, what is family pricing? Well, if you do not have any credit established and someone from your immediate family is willing to co-sign for you, you will get your interest rate based off your co-signer's credit score. What does it mean for you? So our base rate is 2.25% for a 60-month car loan. Our rate for someone with no credit is 6.25% for 60 months. So on a $15,000 car loan, you'll have about $30 difference and over $1,600 in savings over the life of the loan. So that's pretty significant. Now let's talk a little bit about first-time auto buyer. What are the qualifications to get the first-time auto buyer loan? Well, you have to be at least 18 years of age and you have to have valid driver's license. You cannot have any derogatory credit history and no prior vehicle loans on the credit bureau. You have to put at least 5% down payment. It can be in cash or it can be in a trade-in. Maximum loan amount for this program is $25,000 and the maximum term is 6 years. You have to have at least 6 months of continuous employment. But on the bright side, there's no cosigner required, so you can get your first auto loan all on your own. And the last bullet point, I think, makes us unique. We actually give you a rate reduction following 1 year of on-time payments with the credit union and other creditors. You would need to contact us and request us to review your credit. We would pull a new soft credit and we'll base your new rate on the new score that we obtained. So this is, I think, a very good program for someone looking to buy their first vehicle. And speaking of a very good program, I'm going to send you back to Shannon to discuss yet another personalized benefit of being a Dutch Point Credit Union member.
Thank you, Maria. So yes, the last thing we want to briefly mention today is Dutch Point Credit Union's personalized credit review program. Now, we at Dutch Point know that your financial health is just as important as your physical health. This personalized credit review program that we offer allows you to get an annual checkup, if you will, on your financial fitness. You'll get a line-by-line consultation of your credit history. You'll be able to know your credit score, And you'll be able to walk away with advice on how to maintain your credit score or improve it if needed. We have many credit specialists at Dutch Point, and they're definitely excited to guide you down the path of financial wellness. So we encourage you to visit our website and schedule your review today. Our website is listed on this slide, but you can also just go to our website and find information about the personalized credit review program, and we would be happy to help you with that. So in conclusion, remember, your credit union can help you with all of your financial challenges. Dutch Point Credit Union is your local community credit union, and we are here for you, and we are ready to educate, serve, and delight you. And we hope that we've done that today with our seminar. So we have just a couple of minutes for questions. I'm going to just take a moment to stop my screen share and get us back up here. That was great, Maria. Thank you very much.
Thank you, Shannon. That was fun.
That was very fun indeed. Okay, we do have a question from an attendee. Can you consolidate student loans?
So we don't have a student loan consolidation program if you're looking for another student loan, because I know they come with some benefits, but you definitely can consolidate your student loan into a personal loan, or I'm not sure if you're already a homeowner and you could do a home equity loan for that. It would be at a better rate than a personal loan. But we do have options. I would highly advise you to give us a call to our lending center, and they can discuss your situation in detail and find the best option for you.
Excellent. Okay, one other question it looks like here. What is considered a good credit score? I know we talked about you have FICO scores, they range from 300 to 850. So what would be considered a good credit score?
Well, as you said before, the higher the better. But so different lenders have different cutoffs for what they would consider a score to get their base rates. Typically, mid 700s, it's a good, very good credit score. If you're over 800, well, pat yourself on the back because you're phenomenal. Here at Dutch Point, we base our base rates on 720 or higher. So if you're at least 720 credit score, you will get a base rate.
Fantastic. Okay. If anybody has any other questions, you could ask them at this time. So we'll just give it one more moment to see if anyone has any final questions. And it looks like we are all set. So once again, thank you all very much for attending. Thank you very much, Maria, for your participation. We've been very excited to have you.
Thanks, Shannon. Thanks, everyone, for attending. It was a great event. Thank you.
Great event indeed. Thank you all very much for attending, and we look forward to hearing from you again soon. So take care. Have a great night.